Good morning or good afternoon, everybody, and welcome to today's webinar, Top 6 Ways to Originate More Business in Today's Market. As questions come up, please go ahead and use the questions tab. We're gonna go ahead and ask them throughout the webinar just to make this as engaging for you as possible. This is part one. Part two of the webinar is we've got a lot of great stuff to share with you. So we've broken it out into two parts. Part two is next Tuesday, and it should be on your calendar, and I'll go ahead and send everybody a reminder email as well. With that, let me go ahead and turn it over to today's speakers. Take it away, Rob.
Good morning or good afternoon, everyone, and thank you, Rose. Thank you all for joining today. So excited to be on this call with you all. My name is Rob Taco. I'm the regional manager in New England and the Mid-Atlantic, and I'm really excited to have with me on today's call Nicole and Janice. And just to echo Rose's point, we want this to really be an open dialogue. You have a ton of credit knowledge on this call, and I'm not speaking for myself. I'm speaking for the ladies. There's pretty much nothing they haven't seen when it comes to loan scenarios. So put us to the test. We love questions. We feel that a lot of questions results in a rising tide lifts all boats. Everybody will learn non-QM together. So put us to the test, ask us a lot of questions. And with that, I'm going to turn it over to Janice to introduce herself.
Hi, everybody. Welcome. And thank you, Robert. I'm Janice, and I'm an account executive at Lensher Mortgage. And we're really excited to be here and to help you also just think of more ways to close loans, because that's what we're here for, to help you.
Thank you.
Hi, everybody. I'm Nicole Troopy. I'm a regional operations manager for Lensher. I'm also very excited to be on this call, provide some summaries on our products, some helpful tips, maybe some key words, topics, phrases to keep in mind when you're having those conversations with maybe past or future borrowers. So very excited to be here and looking forward to getting the creative juices flowing.
Awesome. Love it. All right, so a little bit about Lensher. Lensher was founded in 2015. Our headquarters is out of San Diego, California. That's where Janice hails from. And we also have operation centers in Rhode Island, Georgia, Utah, and Missouri. Nicole and I happen to be in the Warwick, Rhode Island Operations Center. We've been securitizing loans since about 2017. We have a highly experienced management team. What does that mean? That means we have the same executive team as the former accredited home lenders. That goes back about 16 or 18 years ago. Many of you may recognize that name, although I am aging the executive team there. Let's hope they're not listening to this call, right? Therefore, we have very deep credit knowledge at all levels of senior management. You will see a lot of green there on that map of the United States. I think this year we're gonna start to see a lot of red and blue as we head into this election season. But for Lensher, actually, green means good. And we're lending in all 50 states right now. As you will see in New York, it's a lighter shade of green. That means we can do investment properties only. But pretty much everywhere where you are, we're able to lend. Okay, so this is our first segment. Lensher offers personalized solutions for business owners, self-employed, and gig workers. This first segment is about solutions for the self-employed borrower. This happens to make up about 40% of our total originations, okay? So many of these borrowers just miss agency ratios, debt ratios, and the key here is to really become familiar with some of these non-QM options that we're about to discuss, so you never miss an opportunity. We really want you to be a go-to source for this just miss self-employed borrower. So with that, I'm going to turn it over to Janice to talk a little bit about the demographic of this self-employed borrower.
Thanks, Robert. Well, you hit the head on the nail, basically. There is a huge opportunity, and that's why we want you to basically, get into this opportunity. Freelancers, I mean, there's an estimated 76.4 million freelancers. Think about all those self-employed people who they're writing off everything on taxes, and so they're not qualifying for the loan they want or not qualifying at all. And here's, knocking on the door is opportunity. You literally are going to be their hero by offering them a bank statement loan. The workforce is exponentially growing in this area, so it's a great way to open doors for you to find more loans to do.
Janice, if I could just add to that for a minute. So
Sure.
you mentioned, self-employed is about 10% of the workforce, which is 16.2 million people. So that means there's about 162 million people in the total civilian workforce. And what I want to call out there, I think, which is really powerful on this slide, is freelancers are 76.4 million out of that 162 million people. So that's almost half. That's 45%. So what that means for all of you on the call today is almost 1 out of 2 borrowers that you speak to have some sort of freelance side gig, or as some of the millennials call it, side hustle, right? They have some sort of side gig that is additional income. Now that's additional income that we could potentially use in a non-QM product to help with more purchasing power. So I thought that was really powerful to call out. So thank you, Janice.
All right, so here are obviously some stats, top cities for self-employed borrowers. So you can see a lot of Florida right there, self-employed rate 20.3%, and it goes down, and then you have some LA, so here in California as well, and then kind of what Robert was talking about. There's a lot of young workers that are also starting to do that side business. So 19 to 24-year-olds, 25 to 34-year-olds are at 6.2%. But then there you have 35 to 44-year-olds. They're side hustling too. There's the 10.2%. It just keeps growing. And I think in this economy, everybody's looking to see how do they increase their income, right? Are they going to be side hustling, selling on Amazon, or are they Lyft workers? Are they going from a W-2 job to a 1099 because they can make more money doing the same things? All these things will probably help them make more money to be able to afford a house. So, but they can't qualify conventionally. So then here we are.
All great points, Janice.
Yes. Anyway, so some of the interesting programs that we have here, it's bank statements plus asset depletion. How do we get creative? And I know, I'm sure, Nicole, you see this kind of thing all the time as an operations manager. It's like, hey, this person is self-employed and we qualify off of the bank statements and their DTI still doesn't work. So how do we actually help them? Well, guess what? They also have assets, and we can combine a bank statement borrower and deplete their assets and increase their income. I have one right now that's a retired couple, and then we added assets to help them qualify. The LO tried everything he could conventionally, but they have a lot of student loan debt from their children, and they had to, combine the two. So it's really exciting that we're very creative to try and help the loans work, right? We like to call this the professional program. So basically, people who are professionals, doctors, dentists, lawyers, and they've been in the same line of work forever, but they became self-employed a year ago, or sometimes less than a year self-employed, but they have the history, right? Think of a dentist who's been W-2 a long time, and then they buy a practice, and now they're self-employed. Well, you'd probably need 2 years of self-employment history with any other lender, but with a non-QM lender like LendSure, we're going to take a look at that and say, oh, wow, I have 5 months proof of this self-employed income, plus your 10 years of W-2s. They're obviously a working professional, and we make those exceptions all the time. So there's a lot of hybrid ways to structure loans, and that's what your LendSure account executive will do for you. I get these calls all the time. Hey, I have this guy, or hey, I have this gal, and we start talking about it, and we try and put it together and see how we can combine these type of borrowers and make it work. So it's really it's exciting. Yeah.
If I could just add, Janice, I think that's huge, the fact that we can blend all types of income. You can blend bank statement income with the borrower, and then if the co-borrower is W-2 wage earner, we can do that as well and use all of that income to help them debt service and increase their buying power. And then if you have a borrower who may be on Social Security or pension and they're recently retired, but they have a lot of investable assets, to your point, that's where we can asset deplete. In the conventional world, they call that asset dissipation, and they divide by 360. We get a lot more aggressive with that, and we're going to talk about that in some of the other segments when we get to the high net worth affluent borrowers. So lots of good points there just to bring up.
Okay.
Folks, do you want to go to the next slide?
Okay.
All right. I apologize. My camera is not working right now, but I am here, team. And I just
Yay!
wanted to bring up our bank statement loan program. This is a program that is a way for us to qualified self-employed borrowers' income using their current income, not necessarily off of their tax returns. Conventionally, you must use your tax returns for your self-employed borrower, but instead we're able to analyze their bank statements and give them income for what they're earning daily, weekly, and monthly. So we do offer two different types. We have a 12-month business bank statement program and a 24-month business bank statement program. So these are provided upfront. So for example, in the 12-month business bank statement, we collect 12 months of business bank statement with a self-employed questionnaire. Our self-employed questionnaire, the borrower actually fills out for us, and they tell us how they operate their business. Does the business pay rent? Does the business have employees? What is your payroll? Does the business have a cost of goods sold? Are there utilities? What other kind of reoccurring monthly expenses does the business have? So with the SEQ and our bank statements, we're able to analyze them to give genuine business deposit income, and then we apply an expense factor to that income to then give borrowers monthly income to qualify for a new loan. Now I just summarized this and I did not include the word profit and loss statement, and I did not include the words tax returns. That's huge for our self-employed borrowers. Think about all the pre-quals that you may have had to pass on because they didn't qualify conventionally with 2 years of tax returns. But you know that business is doing well, it's thriving, and maybe the daily sales don't necessarily match the tax returns. The bank statement loan program is an excellent way for us to help our self-employed borrowers in that way. So again, no profit and loss statements are required. We evaluate that income upfront at your pre-qualification process. And we also don't have any verification of the borrower's employment history previous to the self-employment income. Kind of going on that, we also take the percentage of ownership from our borrower for the income. So our borrower doesn't necessarily have to be 100% owner in a business to use that business income to qualify for your mortgage. So for example, very easy math here, if we had $10,000 in income monthly and we applied a 10% expense factor, we are giving the borrowers $9,000 a month in income to qualify for your mortgage. That is anticipating 100% ownership. So if the borrower happened to be 50% owner, in that same example, we're going to give you 50% of the income. So 50% of the $9,000 in income would be $4,500 that we could still give that borrower for monthly income to qualify for the new mortgage. So again, that's huge with no tax returns, no profit and loss statement.
Nicole, Eric wants to know what's the minimum percentage of ownership for this program?
Yeah, so we have seen percentage of ownership as low as 15%. Typically conventional, you want 25%, but we have gone as low as 15%. Self-employed borrowers especially, no two self-employed borrowers are the same. So that might be a case-by-case basis if we need to go lower than 25%, but we certainly have done it.
Okay, he says thank you.
And can I add, Rose, one more thing you did not mention, Nicole, is no transcripts. So no 4506Ts either that we need to fulfill with the bank statement program. So that's huge as well, along with no P&L, no tax returns. The other thing I want to call out that I think is huge here, separates us from the competition of non-QM lenders, is we will go as low as a 10% expense factor. That's a variable expense factor. Many of our competitors will assign a default expense factor of 40 to 50%, which means they're only using 40 to 50% of the total average deposits on those bank statements. We'll go as low as 10%, which means we'll use up to 90% of the average deposits. So that's leaving income on the table, and that would be diminishing their purchasing power if they assign a 40 to 50% expense factor. That's huge, that will go as low as 10%. An example of this is you may have a remote worker who works 100% from home, doesn't report into an office, and is self-employed. they have very low expenses. I mean, their expenses are maybe just supplies, maybe their electricity and Wi-Fi. That's an example of somebody that would have a 10% expense factor, and we'd use 90% of their deposits. The other end of the spectrum would be a restaurant owner. A restaurant owner is very high laden expenses, could be as high as 90%, but they also have a lot of monthly deposits, very, very high. Not uncommon to have $200,000 a month in deposits. So even if we use only 10% of that income with a 90% expense factor, that's still $20,000 a month to help them debt service for purchasing power to buy a home. So I think that's huge to call out. I just wanted to mention that, along with the fact that there's, you know, no P&L, no CPA letter, and no transcripts, no tax returns for this very flexible program where we can either do a bank statement spread on 12 months or 24 months.
Rob, Cindy wants to know, how is the expense factor derived?
So a couple of different ways. So one, there's a self-employment questionnaire that the borrower fills out, talks about, you know, what is their cost of goods sold, what is their payroll, do they pay a lease or some sort of rent to operate their business? Do they operate their business out of their home or out of their office or a plant? And what other expenses that they can tell us about? So we will look at that in conjunction with some of the consistent business expenses coming out of the bank statements. And our credit analysts do a very good job of analyzing the expense factor based on that type of self-employment. So, you know, we understand that a remote worker who works 100% from home is going to have very, very low expenses versus, let's say, the restaurant owner or the home improvement contractor is going to fall somewhere in the middle, right? Because they're buying materials and there's labor involved and they have a truck and supplies and so on and so forth. So they might be about a 50% expense factor. So that's how we derive that.
And Shani wants to know, what are the reserve requirements for this loan, if any?
That's a great question. So typically the reserve requirements is 6 months. In some cases, depending on the FICO and LTV, cash out can be used towards that reserve requirement if it's a cash out refinance.
Now, she has a follow-up question. I'm sorry, she or he has a follow-up question. Can funds in the business account be used for the reserve requirement?
Yes, they can. They absolutely can. We do want to verify that they're 100% owner in that case to be able to use those funds towards reserves.
Awesome.
Janice, Nicole, would you like to add to that at all?
No, I think that would be the multiple business bank accounts accepted. That also is a big point to just mention here. I think that goes along with the question as well. We have the ability to analyze one bank statement. The self-employed borrower has the prerogative to give us whatever bank statement they want us to analyze. But if they do have other assets and other bank accounts, we can use those same business assets for reserves, down payment, and again, for the bank statement for income qualifying.
Okay, great. And I got a couple of questions here. Yes, you are going to get a copy of the slides. Look for an email from me, Rose Waldy, about an hour after the webinar. And that will have a link to the slide deck for this webinar. And, you know, who's your LendSure account executive? If you don't know who your LendSure account executive is, just go ahead and respond to that, reply to that email from me, Rose Waldy, and I will connect you with your LendSure account executive. Jennifer wants to know, do you do second mortgages or HELOCs or HE loans that are bank statement programs?
No, we do not, Rose. First lien only.
Okay, fantastic.
A lot of great questions. Keep them coming. And just to, you know, call out that point that Nicole made, if you have a very complex self-employed borrower with multiple LLCs, multiple business bank statements, we can do, you know, we can qualify them on more than one bank statement spread. So, you know, that, and keep in mind that if they tried to qualify conventionally, that would be very complex tax returns to analyze, and that would be a lot of documentation that they may not want to go through. So this is a great alternative to going full doc conventionally for that very complex self-employed borrower that has numerous corporations. So lots of great points here. Hopefully we hit on them all, and you know, I'll let Nicole talk about some of our talking points or takeaways.
Okay. Before we do that, Scott, yes, you are going to get a recording of this presentation along with the slides. Look for that in an hour. And then before we move on, another follow-up from Shani. For the expense percentage, is a letter from a CPA stating the exact percentage is sufficient to establish what LendSure uses?
Typically, we could accept that, but we want to see that self-employment questionnaire. So their CPA could help the borrower fill out the self-employment questionnaire. We want that filled out by the applicant, who's also the owner of the business. So that's typically why we have the self-employment questionnaire in lieu of a CPA sending us a letter like that. But they can absolutely work with the borrower to help them fill that out.
Okay, great. Thank you.
Lots of great questions, Rose.
Yeah, I agree. And kind of following up for the questions, some talking points that you can use as the broker to your borrower. The first one is perfect. I help self-employed borrowers qualify based on their actual income, right? That would be how we can use the bank statement program rather than the numbers that appear on their tax returns. Again, we all know the self-employed borrower where the business doesn't necessarily match the tax returns that we see. And non-traditional borrowers, that's a great keyword as well. Business owners, your self-employed customers, as well as high commission sales workers. I just want to say this again, high commission sales workers. Just about all of us on this call, you fall into that category, right? So we'd always face challenges of documenting that income. I want to point out this isn't necessarily the bank statement, but going along with our self-employed borrowers, we can do 1099 income, and it's a 1099 plus the self-employed questionnaire. We just look at the income that's on the 1099. I say that because typically, conventionally, you would still need tax returns for our 1099 employees. They usually file a Schedule C, and sometimes the income on the Schedule C doesn't necessarily match the 1099s that you see in front of you. So this is a great way, besides the bank spread income, to allow our borrowers to only have to submit two 1099s, right, 2022 and 2023, and a self-employed questionnaire. That's just even reducing conditions even more by not having to submit 12 or 24 months of bank statement spreads. So especially our high commission sales workers, that comes up very often. But really, it's any self-employed borrower who is facing challenges documenting that income. We just offer innovative loan programs. We're able to overcome obstacles, and we like to, and we work very hard to say yes to these tricky loan scenarios. I'm very grateful to work at LendSure. Our flexibility truly is unmatched. I know I work in the Rhode Island office with Rob Taco and our other senior managers, and the ability to walk out of my office and discuss a scenario in person with your senior managers is just unparalleled. Again, we have multiple centers throughout the country where we do this in every center, and our senior management, like Rob described earlier, is so experienced that they know a good loan that makes sense, even if it doesn't necessarily completely fit our guidelines. And to answer your question, yes, we do have guidelines. They're not as stringent as our conventional Fannie and Freddie, but we do still have guidelines that we have to meet. But the biggest thing is the flexibility. We do also have flexibility to maybe make deviations from our guidelines when we have other compensating factors present. So again, we like to say yes to the loans that make sense. So our innovative loan programs does help you win more business.
Yeah. And keep in mind, you can keep these little talking points handy in your back pocket if you're in an elevator or if you're at a networking event, just like, hey, we help self-employed borrowers qualify. I help non-traditional borrowers. This will help build your little rep for being able to offer what others cannot.
I just want to add, that was really great. There was a lot of discussion about service there. And, you know, being strictly a non-QM lender, we don't carry any Fannie, Freddie, FHA, or VA products. So this makes us subject matter experts in our space for non-QM. And, you know, we want to build a relationship with you, just like you do with your referral community, your realtors, your builders, your CPAs, attorneys, whoever you get your referrals from. And that's all about two things. It's service and communication. And that's what makes Janice one of our top producing AEs in the company, is her service and communication. So I know Nicole talked about how well we operate here in the Northeast, but I can tell you, Janice being in our headquarters in California, they have some great teams out there as well. And, you know, they're blazing the trails as well in terms of service, communication, and partnership. So with that, Janice, do you want to take it away about referral sources and finding leads?
Janice seems to be frozen for a minute. Janice, can you hear us?
And yes, it is really flexible approach. Hello. To have I can hear you. Can you hear me? Yeah. Okay. So basically, this is a fun story. You know, I was out on the field with a loan officer. She has received a loan from her postal annex lady. So I actually went with her to visit the postal annex lady, and we collected that self-employment questionnaire, which was really kind of cool. These are ways to get to know people, right? I mean, you could, and the postal annex lady let her put her cards on a table where there's real estate agent cards and other loan officer cards. But, you know, it's about relationships. She goes in there to her local postal annex. And I was hearing the stories, you know, and as an account executive, you don't often meet the people that you're going to be helping. And that was really cool. But, you know, you hear their stories. Hey, I'm self-employed. I have this box business. I also, you know, do other types of cleaning services. And we're going to put together this amazing program just for her, with her multiple sources of income, right? You're gonna have your bank statements from the postal annex, you're gonna have her Zelle deposits from her cleaning business, and we're hopefully gonna be able to get her a loan. Just like this, you know, there's a lot of things you can do to get these types of clients. Real estate agents, for example, are great clients as well, because they are those 1099s that they're not gonna have a lot of overhead, but you know, they need this type of loan. So we've done several of those. Your best referral source could also be somebody who you already helped with a bank statement loan, and then you get more loans because of the referral. I helped a loan officer do a loan for a guy who had for the last 15 years successfully had a fix and flip business. And he had been turned down by 5 other loan officers saying, I'm sorry, we cannot get your loan to work. And the reason we got it to work is because we took the extra time and we got creative, and we understood the sporadic nature of his deposits, right? Because you're buying a house, fixing it, and selling it. So 3 months, no deposit, then a huge deposit. And then it took extra TLC, what happened to get more documenting of these flips, but we got it done. And guess what? His wife's a real estate agent. He referred 5 other borrowers to my loan officer because he was so grateful, and he got his wife her dream house, right? So there's a lot of ways to get it. Join a social media group, talk to CPAs, financial planners. But honestly, I think word of mouth and something else is that happy loan officer equals a more happy loan officer. Loan officers, they come back and then they talk to, you know, somebody else and say, hey, have you worked with Lensure? Have you worked with Janice? And then it just keeps growing. Same thing can happen for you. Once you help one self-employed borrower, it's a chain reaction. Or they come back, right? And they go, now I want to buy an investment property. Anyway, the possibilities are endless. I know that, like Rotary clubs, going to trade shows, nail salon owners. I mean, just think of your own backyard is literally your playground. You can go, any door you knock outside is going to be a self-employed borrower that you, hey, is the owner here of the restaurant? You know, your local Thai restaurant. You know, there's just so many different possibilities, but hopefully this helps you think of ways to get some leads and send us some loans.
All right. And to help you in your endeavors, I have put together these marketing resources. In that email that you're going to get from me, you're going to get a link to different marketing resources that are available. These are flyers, we've got email templates, slide decks, banners, and everything, so that you can, on these, you can put in your logo, your contact info, and even your disclaimers at the bottom of these, and you can start reaching out to people right away. So look for a link to these in the thank you email that you're going to get from me about an hour after the event ends. Before we move on, Kellen wants to know, you mentioned a 1099. What type of loan is a 1099 form?
So 1099 would be for the self-employed borrower who receives a 1099 for their employment. Instead of using tax returns, those borrowers typically file a Schedule C. Then they have all their write-offs and deductions, and then their adjusted gross income is what they would use to qualify for a conventional loan. Okay, so if they write off a lot of that 1099 income to a very low taxable income number, and it doesn't help them qualify on the conventional side, we might be able to just use 1 year or 2 years 1099s with the self-employment questionnaire, and that's all we need. We don't need the tax returns. We can go off that gross 1099 figure or multiple 1099s, apply an expense factor from them filling out the SEQ, and we'll close the loan. We'll debt service the loan based on that. So hopefully that explains it.
Can I also just add an example for a 1099 borrower? So this is going to be your contractor. A 1099 is an end of year document that is given to your contractor borrowers that does not include taxes taken out. So where a W-2 borrower, you see taxes and other items taken out, a 1099 is given to a contractor that's strictly the income that they have earned throughout the year, and it's their job now to claim the income and pay taxes on their own annually. A great example of this, and we have this all the time, I would say, is an IT consultant. You have an IT consultant that works for multiple companies throughout the year, and they receive 1099s for their income. We do a lot of IT consultant when it comes to 1099s, also broker and realtor partners as well.
Okay.
Rose, can we step back one slide for a minute? I just wanted to comment on that. So I wanted to comment on these marketing resources. So folks, you can all use these marketing flyers that we have. We call them private label flyers. You can put your information on it, your signature line, your logo, your photograph, and you can hand these out as your own. And we have these flyers for all of our products. So this is really powerful. I mean, you're using our marketing dollars and the creativity from our marketing team to put to work for you to advertise that you offer these products. So this is really the first step, right, to becoming familiar with non-QM and seeing more non-QM referrals, is offering up these flyers, handing them out, maybe doing an email blast. And then when you have a referral partner that wants to talk more about a specific product, you bring the account executive on the phone. We will partner with you. We'll do a three-way call. We'll talk through this more with you and your referral partner. We'll be your subject matter expert, and we'll go over this. And that's, again, how we talked about earlier. I mentioned, I know it sounds kind of corny, a rising tide lifts all boats, but that's how everybody learns, right? We're going to coach you. We'll start by doing a three-way call and maybe coaching that referral partner, and that's how everybody learns non-QM together. And that's how you capture more referrals and grow your business for 2024. And that's a good partnership. So Rose, with that, you want to go to the next slide?
Yep.
All right, so I'll take this. So LendSure, this segment is about expanding property investor business, creating a stream of repeat business. I think Janice touched upon this a minute ago, that even in your own backyard, there's a number of people that you can help, and they become really good sources of referrals for you. This segment hones in on investors that buy and sell investment properties, or they maintain a portfolio of them, many times a dozen or more. It's not unusual for a property investor to have a portfolio of 20, 30 properties. And oftentimes they come to us and they want to buy 10 in a row, or they want to refinance 10 in a row and pull cash out to buy 10 more. Not uncommon. So cash out refis, new property purchase, even 1031 exchanges. LendSure is your go-to lender, whether they want to qualify full doc and use income to qualify, all doc, or DSCR. And we'll dive into that a little bit more.
Well, before we move on to the next section, we really touched on something with that 1099 stuff. So we got a couple of things. First of all, Kellen says about the 1099. Whoa, cool. When would this be better than a bank statement loan?
Yeah, so that's a great question, right? So, your account executive will advise you on that. They'll ask you a series of questions. Our account executives are very experienced. They think more like a lender than a salesperson. At least my team does. I know we all are kind of trained that way. But they'll talk to the broker. They'll talk to the loan officer about what the deposits look like on their bank statements, and if it makes sense to go with the 1099 program. To Nicole's point earlier, they might be paid with a 1099. And that's typically how they're paid and how they file their taxes. That might be the way to go. So it really depends on how they're paid by their clients, if they're paid with a 1099 or if they get Zelle deposits or checks in the mail for invoices. We need to kind of interview the borrower and kind of understand what that borrower's business is like.
Okay, we're going to move on to the next section now. Sorry about that.
All right, so I'll take the slide. So really what this calls out here is, this is a graph from January of 2019 all the way up through the middle of last year, June of 2023. So you can see pre-pandemic, the amount of investment property purchases was hovering under 20%, and it dropped as low as 15%. But then during the pandemic, it slowly started to climb. Investors started entering the marketplace and buying up property. A lot of it had to do with the limited housing, right? Limited inventory, limited housing for people to live. But as you can see, this is powerful. It went up around 28% midway through 2022, and right now hovering about 25%. So what does that mean? That means 1 in 4 purchase transactions are investment property purchases. So similar to 1 out of 2 borrowers that you speak to might have a side hustle or a side gig that they're self-employed, 1 out of 4 purchases, or 25% of the purchases out there, may be an investment property. So we really want you to hone in and understand these different self-employed programs and options available through non-QM, and the investor market opportunity available through non-QM as well. I mean, right now, our DSCR program and our investment property programs, the interest rates are pretty darn close to conventional interest rates, and they can qualify without income income verification or a DTI through something we call a debt service coverage ratio. So, you know, that's really important. We're going to talk more about that in a minute. And with that, Rose, if there isn't any questions, let's go to the next slide about profiles that Nicole was going to talk to us about.
We actually have one question. This is an interesting one. Someone has a Canadian resident looking to invest in Hawaii. Can we do it?
So yeah. Yes, we can. We just had a Canadian foreign national buy an investment property in Florida. So that's a foreign national loan, and we're going to talk about that in the next webinar that we're doing, I believe, scheduled for next week. But we can absolutely help in that case, as long as it's a second home or an investment property. Janice, I think you've had a few of these you've done.
Mm-hmm.
Oh yes, I've closed many foreign national loans, and whoever asked that question, I encourage you to reach out to your account executive, because that sounds like you have a live deal, and we close investment properties for foreign nationals all the time, and it is a great program, and we'll go in depth in the next webinar, but they're very simple. You should not feel overwhelmed by those. Your account executive will walk you through it. If you don't know who it is or you don't have one, reply to Rose's email, and then she'll connect you with somebody. Maybe it'll be me, who knows?
Great point. Awesome. Very good point.
Excellent. And going into some of the borrower profiles that we do see for our real estate investors, I think typical when you think of real estate investors, you think of HGTV, Chip and Joanna. It's a fix and flipper, right? So they purchase a property that needs some TLC, they have a construction budget, and then after completion, they either sell it or refinance the mortgage. We do have a fix and flip product, and that is available nationally. Another borrower profile is a first-time investor, right? The phrase "everybody has to start somewhere" comes to mind. A lot of competitors and conventional doesn't allow first-time investors on their programs, whereas we do, and we actually encourage it. If our borrower has been saving up $200,000 for a down payment, has been at their company for 5 years, has owned their primary for 5 years, and has maintained a mortgage payment, that's a perfect candidate for a first-time investor loan. Another profile may be, this is a little bit of an older term, but mailbox money. Back in the day, if you had a rental property, your tenants would truly mail their rent checks to you. So our borrowers did nothing but walk to the mailbox, collect their rent check, and go deposit it in the bank. So our borrowers who are savvy in real estate understand that rent is continuing to go up, just like our home values are continuing to go up as well. They understand that real estate is a smart investment in their future, or maybe even retirement. When we say college investors, we're really more talking about focusing on college towns, if you will. Again, I'm in the Northeast, so Boston is the perfect hub for very good colleges in the country. We have a lot of people who will purchase investment properties in the area of a college, knowing that they can get rent monthly by room, by entire apartment. We have some people, especially in the seaside towns here in Rhode Island and New Jersey, where they'll do a student rental from September to May, and that's a monthly lease that they have. And then from June through September, they'll actually do short-term rental on Airbnb and rent the property that way. There are so many different ways that we can do investment loans for, like I said, in college towns, different resort communities, etc. Another profile, and we just touched upon this, would be our foreign national investors. Again, just speaking from experience in the Northeast, we have a lot of Canadian borrowers who are looking to start or expand their US real estate portfolio. So the most recent one that we just did, like Rob talked about, we had a Canadian borrower who purchased an investment property in Florida. We have a lot of Canadian borrowers who are purchasing, quote, right over the border in Maine, Michigan, North Dakota, things of that nature. They understand that the real estate market is up and coming in the United States, and we do have the ability to do investment properties for our foreign national. So those would be our borrower profiles. And the last 2 points are really for our established real estate investors and, once again, people who are looking to create their real estate portfolio. So when we say turning a primary into an investment property and no DTI issues, truly that means a borrower has the ability to retain their primary while upgrading to a new primary. And what we can do on the existing primary is, through our data analytics, assign a market rent to the exiting primary. And that helps either offset mortgages that are on that current primary where you can't qualify conventionally because of it, or it may even give that borrower additional income to qualify for the new primary. So that's definitely something that separates us from competition, and especially separates and may help you on a conventional loan that maybe didn't cut it because of that. So this is an ability for our borrowers to start their investment portfolio, right? Their current primary, turn it into an investment property, and they are able to purchase a new primary. And then kind of going on the other side are very established borrowers. We are very, very familiar with the 1031 exchange. Now for this very, very basic definition of what a 1031 exchange is, we have an investor who sells an investment property. There are tax benefits in a 1031 exchange, and they will use the proceeds from the sale to then turn around and purchase a similar investment property. So a 1031 exchange is the ability to continuously grow your real estate portfolio. We do these all the time. We know who needs to be involved in 1031 exchanges. We know how we have to disclose 1031 exchanges. And we also understand that there is a pretty sensitive timing aspect to 1031 exchanges. And again, our team very familiar with it, and we do them all the time for our investment properties.
If you're interested in learning more about 1031 exchanges, go to our website. Under broker resources, you'll see our library of mortgage professional webinars. We did a whole webinar on 1031 exchanges, reverse 1031 exchanges, and reverse 1031 exchanges using our bridge loan. So you might find that really interesting. Again, go to lensure.com under broker resources and check it out.
And I just want to add, Rose, that's a really great webinar, extremely informative about the 1031 exchanges. I would be remiss, being that I'm in the Northeast, if I didn't mention the fix and flip borrower profile on that prior slide for investors. Being in New England here, there's a lot of distressed homes, and you have a lot of investors buying distressed homes, fixing them up and flipping them, or fixing them up and holding them and retaining them for long-term rent. So fix and flip really resonates with your realtors, especially in the Northeast. If you have anything like that, fix and flip is under our specialty loan program out on our website, lensure.com. You go to specialty loan programs. There's a whole section on fix and flip. There's a short video to learn more about that. And there's even the online form to apply for a fix and flip refinance or a fix and flip purchase. So a lot of great stuff on our website. And that's exactly where you can find everything about fix and flip, or you can call me if you're in the Northeast and I'll walk you right through it. Incidentally, the fix and flip team is out in our headquarters out in San Diego. Janice probably knows them all very well. And that's a fantastic team. They're, you know, very tenured. They know what they're doing, and they have about 500 under their belt. So we kind of, I think we've cornered the market on fix and flip. So just wanted to call that out again, but I appreciate it, Rose. And yeah, let's go to the next slide.
All right, and Nicole, before we get into the different loan options for property investors, Kenya wants to know what's the maximum loan amount for investors, and Grace wants to know what down payment is required for first-time investors.
Yeah, so typically we are looking for a 25 to 30% down payment for our first-time investors. Every scenario and borrower can be reviewed on a case-by-case scenario. If we are able to do less down payment, we will, but that is typically what we see. And I'm sorry, Rose, what was the first part of the question?
Kenya wanted to know what's the maximum loan amount for property investors?
So maximum loan amount, we like to stay under 2 million, but we have an appetite for a little bit more if needed. Again, when we're getting into the higher loan amounts, definitely bring it to your account executive and we can see if between senior management and the account executive, we can make a loan that makes sense.
Okay, and Vicky says no lease required on the primary property when using rent?
Correct. For the exiting primary property, your borrower does not have to have that leased yet. That is huge. That is a very
Huge.
big selling point, especially the borrowers who don't want a bridge property because they don't want to sell that property, the exiting primary, but they know that they are going to eventually rent it out. There is plenty of analytical data that we can find to give it a market rent value.
Okay, great.
And going into our investor loan options, there are 3 different ways that you can qualify for an investor loan. Now, the first 2 columns go over income qualified. So full doc, very typical for you, the least amount of risk, so has the lowest rate. So that would be your tax returns, your W-2s and pay stubs, your 1099s with your SEQ. The second column is the bank statement. We already went over that. Rates would be mid-range. Again, a little bit more risk because we don't have full documentation there. Does have a DTI, those first 2 columns. Now the third column I really want to highlight, Rob mentioned this already, the debt service coverage ratio. How I can compare this, if anybody has ever originated an FHA investment or a multi-unit property, they know that a requirement is that the gross rent must cover your full PITIA. So for easy example, if our PITIA is $1,999 and our rental income is $2,000 a month, it's an even wash. Our rental income covers our PITIA. In our DSCR program, that is it for income. We do not need the borrower's bank statements, 1099s, tax returns, nothing. As long as in the DSCR program, it's an investment property only, and the gross rents cover your total PITIA. Now, we typically want our DSCR to be 1, but what happens when your PITIA is $1,999 and the market rent is actually only $1,900? At that point, we would have a DSCR ratio under 1. We don't say no, it's not a deal killer, but at that point, we would need to revisit that with our senior management team and again, present the loan and the other compensating factors that are present to continue with a DSCR less than 1. I think something really big here is I just want to stress no income docs. No income docs, especially our really established real estate investors who have 15 properties. Each property has its own LLC, which then files its own tax return. They have 2 businesses that they file tax returns on, and they have a W-2. Those borrowers are not talking to you. They do not want to provide all of that income documentation. They just want to buy their properties that they know are going to make them money and they know that makes sense. A DSCR program is a perfect loan program for our real estate investors who are experienced this and they know good properties that are going to rent well and are likely going to give them a DSCR at 1 or above anyways. So not right here in the column, but something to most definitely highlight is that we will allow both long-term, so a leased rental income, as well as short-term rental income. That is huge when you think about condos in Florida, right? Always the first thing that comes to mind. Short-term rent would be properties that are listed on Airbnb, VRBO. I know Janice and I were talking about traveling nurses. So we have investors who are putting their properties on travel nurse websites, knowing that these are good tenants that are going to pay nightly, weekly, even monthly rentals. It's still technically a short-term rent. A lot of our competitors and a lot of conventionally, you cannot qualify off of short-term rent. So that is huge in our DSCR program as well. Obviously, without income documents, we have the most risk out of the three columns. So we do have the highest rate, if you will, but it is still, to Rob's point, comparable to conventional investment property rates. The fourth column, like we were just mentioning, is the fix and flip. So we have plenty of information and marketing pieces on the fix and flip on our website, but basically no income. Once again, that DSCR, up to 85% loan to cost. So notice that doesn't say loan to value, because in a fix and flip, we are taking into consideration the purchase price and the construction budget as well. So that's what we mean when we say up to 85% loan to cost. This is going to be an investment property only, business purpose, closing in an LLC. We do accept first-time investors. Again, you see first-time investor as a keyword continuously popping up here. Mid-construction accepted, 1 to 4 units. And in the fix and flip program, we will go up to 2 million, like we kind of touched upon already.
Okay, and if anybody's interested in learning more specifically about our fix and flip program, there is a recorded webinar on our website under the broker resources section. So please feel free to check it out.
Yeah, so I just want to add on this, if I could, Rose, could we step back for a minute? Just on DSCR, I just want to add that unlike calculating rental income full doc, where you take a 25% vacancy factor and use the gross rents times 75%, we can use 100% of that rent to calculate that DSCR. Now, if the DSCR falls below 1, as Nicole mentioned, it's not a deal killer. We have creative ways of bringing that DSCR back up. As she mentioned, the debt service ratio is divided by taking that gross rent and dividing it by the PITI payment. Now, what we can do to bring up that DSCR is we can use an interest-only product where it's just, instead of principal, interest, taxes, and insurance, it's just interest, taxes, and insurance, and that's what you're dividing the gross rent into. So it's a lower number, it's a lower monthly payment, it increases cash flow for the investor, and it's one of our solutions to help bring the DSCR up back to 1 if we fall just under that. There's things of that nature that we can do. We can also talk to the broker about buying down the rate, possibly by paying points and lowering the interest rate. And that would lower the monthly payment, which would increase the DSCR. So we have a number of creative ways of increasing that DSCR, and your account executive will go over all of those with you. So I just wanted to call that out before we go to the next slide.
All right, and speaking of DSCR, Kenneth wants to know, how do you order the appraisal if trying to use STR on a DSCR loan? I'm not sure what STR is.
Yeah, short-term rents. Yeah.
Got you.
So we are going to ask in a DSCR program for the appraiser, whether we're using long-term or short-term rent, to complete a Form 1007, which is a market rent analysis, and that is how we would derive the monthly rental. Now, short-term rent is a little bit of a pain point for a lot of different loan officers right now, especially because different states have different requirements on who can make comments on short-term rents, but typically it is ordered on a Form 1007. If there was ever a hiccup or a reason why they can't provide a Form 1007, we do have alternative documentation we can request, but I'd say 8 times out of 10, it's right on the Form 1007 that we use to qualify.
Okay, great.
I'm sorry, I just have to say something. Sorry. I've saved many deals with, and we allow this, and it does not, you know, if that 1007 comes in with the long-term rent, because the appraiser is not comfortable, they're not, you know, adequately trained to give you a short-term rental income on the 1007, that's okay. Lensure will pull a AirDNA report and use that to qualify with the short-term rental income, as long as it meets our requirements. If you're not familiar with AirDNA, it is a website that pulls analytical data from Airbnb and VBRO, the short-term rental websites, and it actually will derive a short-term rental income for you, and we will allow to use that. So just, I had to jump in because I love that. I'm such a nerd for that website. I think it really helps save deals. And just so you all know, right now, the adder for a short-term rental income is only a quarter, which is way better than if your DSCR is under 1, the adder is more. So that's always a great solution. And guess what? Your investor's gonna go, wow, I can make this much money with short-term rents. I'd rather short-term rent this property. So anyway, thank you.
No problem. Janice, Kenneth wants to know, as the LO, would you take an Air DNA from the agent?
No, actually, I mean, you can use that and send it to us. I believe if it meets our requirements, we could use it, but if not, Lensher has the ability to pull their own Air DNA report.
Okay, fantastic. And Vicky, yes, you're going to get a copy of the slides. Look for the email from me in about an hour. And your AE, I'm not, I will connect you with your AE. Just reply to the email. Just reply to it and it'll come to me and I will connect you with your Lensher account executive. Great.
Awesome. A lot of good questions, Rose. A lot of great questions.
Yeah, and so the program highlights for our investment property borrowers would be, again, that short-term rental income. We can qualify that on DSCR, like Janice just mentioned, with an Air DNA as an alternative documentation. And we're going to jump into this next meeting especially, but condotels, we are not scared of them. We're actually up for the challenge. Condotels, non-warrantable condos, resort communities. When we say resort communities, again, I'm going to give you an example. In Florida, you have an HOA that's surrounded by a golf course. There's a club fee that's due. There's a typical HOA fee that's due. We do resort communities all the time. We do just make sure that any mandatory fees are included in the PITIA for qualifying. And we've already talked about this, but it's definitely worth repeating. No limit on the number of loans to a single investor. So again, think of those investors that already have 15 properties and they continuously buy a property in 1 year and sell the property in the same year, right? That's just reoccurring business for your realtor and yourself. We can close in an LLC or revocable trust. A lot of our competitors and conventionally limits you in that case. How the borrower is vested is how the borrower wants to be vested. So we may need some additional documentation, but we absolutely can close in an LLC or revocable trust. And this last one, I know we're going to be very excited and we are going to dive into much more detail next week about this, but we do allow a DSCR up to 8 units, right? Conventionally, you're maxed at 4 units. We do have a 5 to 8 DSCR program available.
Okay, fantastic. And Semi wants to know, how does the LTC and ARV work on a fix and flip?
So I can take that, Rose. Honestly, this is very much case by case. When it comes to fix and flip transactions, there's a number of things that are taken into consideration to determine what that loan to cost maximum percentage will be. A lot of it is based on the experience of the flipper. We want to see if they've had at least 3 flips in the last 24 months to go to those max loan to costs. But at the end of the day, the after repair value or the ARV, we want to be no more than 70% of that number. So that after repair value is after all of the improvements in the plans and specs of what they're going to put into that property. And based on the location and the comps around that property, what is it going to be worth after the repair and the renovation? We want to be no more than 70% of that number. So that's hopefully that answers the question. But I will just say that that is very much case by case. And the transactions are looked at very closely in terms of what is the exit strategy, what's the investor experience, and what is the scope of work, and what are they looking to do to that property? And above all, what is the location of that property, and what are the comps that are going to determine that after repair value? So, you know, with that, I would highly suggest listening to the webinar you mentioned and going on our website under specialty loan programs and looking at our fix and flip product, and you can apply and submit the form right on our website. It takes 5 minutes to fill out the form.
All right, fantastic. And just like in the other program that we discussed, I will be sending you a link to more private label resources. These ones are specifically on our DSCR program. This is a great program to reach out to your realtors. Again, this program could lead to lots and lots of business down the road. There's also a section on fix and flip loans. On private label resources here. And again, on these, you can add your logo, you can add your contact info so that you can start reaching out to people and growing your business right away. Now, we are a little behind our time, so we're going to get through this last section and then we'll continue with our Q&A. So Rob, take it away.
Yeah, I'd be happy to, and we'll try to make this brief because we're coming up on the hour. So LendShare offers specialty loan programs for affluent borrowers. In this segment, we really just want to talk about the affluent borrower and who exactly they are and how we can help these high net worth individuals and the solutions that we can offer. In some cases with very limited income documentation as well, that we can come up with a solution for them to buy a home. An example we'll get into is asset depletion or asset qualifying and converting some of those investable assets into income. And we're going to talk about that in some of these slides to come. So let's go to the next slide, Rose, without further ado.
All right, so some of these loan programs we already talked about, and you can also offer so you're familiar with. For example, the first column, we have jumbo loans, definitely similar to some conventional products with a couple of caveats. If you do have jumbo loans, please reach out to your AE and we can discuss the differences and how we may be able to qualify those jumbo loan borrowers. The second column is the bank statement loans. We went over that in depth. Just again, want to bring up, we can go up to a 90% LTV for those borrowers with no PMI. No PMI at all, between 80% and 90%. So that is huge. The third column is our asset depletion asset qualifier. So this is another way that we can qualify borrowers to give them income without them actually providing income documentation. The most recent one that we had a borrower had $3.1 million with Merrill Lynch. They wanted to buy an investment property for $300,000 and they wanted a small loan to do so. Instead of liquidating more funds than they needed, they've liquidated just for the down payment and the closing costs. We were able to assign an income based off of the $3.1 million that they hold in assets. So the borrowers provided their asset statements, did not have to provide income, and was able to get their investment property that way. We are able to use asset depletion and asset qualifier on primary homes, secondary homes, and investment properties as well. So you'll see we will go loans up to $3 million. Our qualifying assets, we will use 100% of liquid or cash equivalents, 80% of stocks and bonds, 70% of retirement accounts. And I also want to mention that we will use a combination of those very often. So we have a borrower currently who has about $200,000 in Chase Bank. They've got about $500,000 in stocks and bonds in the market, and they also have a very healthy, almost $1 million in an IRA. We are able to use those asset numbers to give them monthly income without the borrower having to provide income. So very big, especially with borrowers who have maybe income or documents that are very sensitive in nature and they only want to provide the assets to us. This is a great way for our affluent borrowers to provide assets and still qualify off of income for the new mortgage.
Okay, and again, guys, don't worry about having to jot all this stuff down and everything here, try to remember them. Just look for the email from me within an hour, and it's going to have all of this information. Now, Vicki wants to know for the bank statements, is it personal bank statements?
They're able to give us personal or business. It really is their prerogative. If there are bona fide, genuine business deposits in a bank account, the same thing applies. We need to confirm ownership of the account, etc. But you can use both personal and business.
Yeah, Vicki also commented, I have affluent retired borrowers. That's an excellent point.
Absolutely. So those retirement borrowers are very, the accounts, I should say, are very healthy, right? So you're seeing these borrowers with IRAs and retirement accounts of $1 million plus. We would be able to give them a balance. If they had $1 million, we'd give them credit for $700,000, and then we'd use that balance to use asset depletion there. So that's very common, especially our retirees that want to invest in future investment properties.
Great.
I have to say, okay, these are really fun loans to do. I would say the asset depletion program for me has really saved some files. You can go 100% asset depletion, and that's the only income, kind of like Nicole mentioned. She said, you know, they don't even want to send you anything else because they have all this money. But you can also combine things like I spoke about in the very beginning, like hybrid. But, you know, how do you approach these kind of borrowers? What kind of things can you say to them, you know? And you can always say, hey, you can always qualify without income, right? If you have enough assets, we can just use 2 months of bank statements and deplete those. And we have several ways to do that. And a lot of people are going to jump at this chance, right? You meant a lot of people mentioned on the chat, people who are retired and they just have all this money. Maybe they sold a property and they have, you know, $2 million in the bank they're looking to buy. Instead of using that and using all their cash up, they can finance based on just that. So, you know, there's a lot of different things that you can kind of approach this, but say, hey, you know, I have a very simple solution for you. You're the right borrower for this type of program. And then you contact us and we structure it for you. And this goes along with all our types of loans, right? So I really think that I enjoy this program, and I think it also saves deals where income's not quite enough, but they do have, you know, a 401k with 400,000. So it's a great one. But I always say, always ask how much money they have, because they might be hiding some money there that could end up helping them qualify for a loan. And I know some borrowers don't want to tell you everything, right? I'm sure you've probably heard that, you know, why do you want to know? It's not so we have to make them put more money down. Sometimes it's just so that we can increase their income and they qualify. But these are great borrowers to tap into.
All right,
I would just
fantastic.
add, my account executives enjoy this program a lot. It tends to sail right through underwriting very quickly. They're not difficult underwrites as well, so it's a win-win for everybody. Before we close it out, Rose, I just want to make one quick comment. I mean, so, you know, despite low inventory of homes right now and higher interest rates, there's still ways that you can confidently grow your mortgage business. And that's what this entire webinar was about today. The key to that, we feel, is to expand your network and partner with the right contacts. And that's where we come in. And it's all about partnerships, service, and communication. Folks like Janice, top producers like Janice, that are going to help you grow your business. And we want you to expand your network by partnering with professionals like her and like us, of course. So just wanted to add that, Rose, before you wrap it up.
All right, well, we still have a few questions here and they're still coming in. So if you have more questions, please go ahead and use the questions tool. We'll get to them. Greg wants to know, if a borrower is 50% owner of an LLC, but received guaranteed payments, can we use 100% of guaranteed payments verified via 12 months of bank statements?
I will take that one. I know that we say this a lot, but especially our self-employed borrowers, it is case by case. But to give you an example, for guaranteed payments, we analyzed a self-employed borrower's personal bank statement, because in the personal bank statement, the guaranteed payments were the only income. So we were able to give him 100% owner of that bank account, because the guaranteed payments are 100% that borrower's. So we do have ability to give income for the guaranteed payments, even in a bank statement program.
All right, fantastic. And Shani wants to know, do 1099 loans have the same reserves and expense requirement guidelines as the bank statement loans?
So
Yes.
I'll take that, Rose. I would say it's very similar. But again, we're gonna calculate an expense factor based on that self-employment questionnaire that we provide. So a lot of interest in that 1099 product. So that's great to hear. Hopefully that answers the question.
Gary says, I was told by a self-employed buyer that his accountant, not all jobs he worked during 2023 are required to issue a 1099. Any idea how I might document his income from a company that does not issue 1099?
That might be a good one for bank statements. If they're not issuing a 1099 and they're paying him by check or by Venmo or somehow, and that's going into his bank statements that we can verify as deposits, then we would apply, obviously, an expense factor and go off those average monthly deposits minus that expense factor.
Okay.
Janice,
and Eric,
did Janice want to add to that? Janice, did you have anything to add to that? I think I pretty much covered it.
I think so. And I think we always look at these case by case. So we'd find out, you know, the best way to make it work.
Okay, great. And then Eric wants to know, what's the minimum amount of time being self-employed?
That's a tricky question.
Typically, we are looking for a 2-year self-employment history. Now, are we able to make deviations to that? Yes. Our most common theme, I guess, with the less than 2-year self-employed are our tradesmen. So you have an electrician who has worked for a company as a W-2 employee for several years. I'm talking, went from a journeyman to a master, has been there 5+ years, but they decided maybe 16 months ago instead of 24 months ago that they wanted to start working on their own. They're using the bank statement program. We're analyzing 16 bank statements to see that their cash flows and their business deposits are strong enough to be considered for monthly income. So the answer is 2-year self-employment history. We do have the ability to make deviations to that self-employment time frame with the right compensating factors on the loan.
Right. And then last question, Greg wants to know, do we have ground up construction program?
We do not typically.
We do not. Yeah.
But they're
All right.
working on it though.
Yeah.
They are working on it. That is true. Yeah. It's a
They
great
are.
question.
And if I could get the fix and flip department to pop their head in, they'd say really coming very soon. So check back with us.
All right. Well, with that, I want to say thank you, everyone, for joining us today. Again, look for an email from me, Rose Baldy, in about an hour. It will contain the recording of this webinar. It will contain a copy of the slide deck, and it will contain those private label marketing resources for you. So, Rob, any parting words for our audience today?
No, I think I've said enough today, but I just want to thank Nicole and Janice and yourself, Rose, for being on this call. We had a lot of great engagement, a lot of great questions. I thought we were going to get stumped today, but we didn't. We almost did. But I thought this was really great, and hopefully it was as helpful to all of our audience that are listening in today. So thank you all for joining again.
All right, Janice, any parting words?
Well, again, thank you everybody for being here, and honestly, reach out to us. We want to help you close more loans. I know sometimes it feels like times are tough. If you're on this call, don't give up hope. There's so many people out there who are going to be appreciative of your alternative loan solutions, and that's why we're here. We're here to help you close more files, structure things. Don't be afraid if this is your first non-QM loan. I promise you that we have a team of experts in-house to help you pre-qualify the borrower. So reach out to us, and we look forward to closing loans with you.
All right. And Nicole, any parting words?
Yeah, so thank you everybody for your time today. It was a great webinar and discussion. I hope that you were able to take some keywords, maybe some talking points, topics, and really got you thinking about maybe some past clients that you didn't think you could ever help, and just to remember for your future conversations with future borrowers as well.
All right. Thank you so much, everyone. Have a great time.
Thank you.
Thank you.